information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. This is a special shares edition brought to you straight from the Australian Stockbrokers Awards in Sydney. And we're going to be joined by a range of experts to answer your questions and your emails. If you would like to send in an email for future shows, please email us at yourmoney@skynews.com.au. And in this very special first segment, we're joined by Ben Clark from TMS Capital and also Andrew Tracey from JB Weir. I think one of the things that a lot of investors have been talking about and thinking about is how bond yields impact on the market. So, Andrew, we might start off with you. Where do you see bond yields heading at the moment and how do they impact on the market?
Yeah, it's a fairly common topic around the market at the moment, not only here in Australia but also internationally. I think if we look at our Goldman Sachs forecast, the Fed is due to be tightening rates in the US. It was in September and they're now pushing that out to December of this year. In Australia, I think last I looked at the futures market, there was another rate cut priced into the market. But when you're looking at bond yields, the risk-free rate is an input into every valuation that you value companies at on the ASX. So if you're looking at an industrial company and bond yields are rising, then you're going to have a consummate effect in a falling in the valuations supporting those share prices. So I suppose the best way to give an example of that is if you go back to the 1990s, interest rates, a lot of the investors will remember interest rates were at 17%, came all the way down to 7% throughout the 90s. And all the retail investors who were holding bank shares had a fantastic run of bank shares through that period. As the interest rates came down, the valuation support jumped up to support the rising share prices that we saw over that period. So that was one really good aspect of it. I think we're now at that other point in the cycle where rates are starting to tick up at the long bond end. So the risk-free rate is ticking up. So some of that valuation support will start to be dialed back from the market. So high yield industrials, long duration assets like tollways, infrastructure, transmission, utilities, telcos, those sort of ones will start to have their valuation support pull back when the market starts to see the rising rates actually come through.
Okay, so maybe a little bit of cautiousness in terms of some of those yield stocks, and it's probably a good time to go to our first email of the night. This one comes from Laura, and Laura asks, what's your top recommendations for dividend stocks? So we'll go to you, Ben. Yep. Do you think it's a good time to be thinking about dividend stocks, and what would be your picks in this space?
I think everyone's thinking about dividend stocks because of, the sheer wave of people hitting retirement and the alternative, the cash environment that they're coming into. I think what Andrew said there is absolutely right. So one thing I'd say is that you want to look for probably companies who have got net cash or little levels of debt, because that is one impact. If you look at infrastructure assets as an example, a lot of their debt's priced over long bond yields. So that's going to become more expensive and their earnings are going to have to grow faster than that to keep growing. One we've been buying recently, I won't go into all of them, but is Dulux, which has had about a 12% sort of pullback recently. But we think it's a business that's on a yield of about 5.3%. And I'd say, Julia, that it's not just important to look at the dividend yield now, but it's where it'll be in the future. You want to buy that growing dividend yield because you'll get capital growth along the way as well, but your spending power will stay ahead of inflation. And Dulux looks good to us in that new housing construction and renovation activity we think is going to be really strong for the next 3 to 5 years on the East Coast. Mike Baird's fast-tracking 400,000 new homes. Dulux controls 90% of the paint market. It's got a return on equity of nearly 40%. It's one of the highest in the market. It's a very good quality stock. So that's one I've sort of been talking to clients about in terms of investing in.
Okay, so some really good points there. The rising bond yields impacting on highly geared companies, so companies with a lot of debt, but also looking for that growth in earnings from companies like Dulux to help support that dividend. And Andrew, it's probably a good time to be talking about banks, something that we traditionally associate with the yield trade. And we do have an email here from Mike. Are the banks a buying opportunity at current levels? So given what you said about the the bond market, what do you think of the banks? Would you be buying?
I think the banks at the moment, we've got a reporting season coming up in August at the moment, and I think that'll really judge the sentiment of the market for the balance of the year. Retail clients should probably have somewhere around about 40% of their portfolio in banks. And because of that spur we saw in the 1990s of banks having a great run, a lot of retail clients have got significantly larger holdings than that. We don't have a problem having exposure to the banks. In fact, for the next period up to and including that reporting season, we see them as a bit of a safe haven in the market. So investors can hide in the banks, for want of a better word, because there's a lack of earnings risk in there. We've seen a lot of highly rated stocks in the market get smashed in the last couple of days, disappointing in earnings and numbers that have come through to the market. So the banks are a nice safe haven at the moment. But with rising bond yields, and we've actually seen the sector now go come issue with NAB raising $5.5 billion. So they've tapped the market for that, which I think is a good move for them to do that. The regulator will keep talking and making more noises about banks having more capital. So it wouldn't surprise to see other capital raisings other than the organic capital raising that the banks are doing. So that's one thing that I think investors don't want to be massively overweight the banking sector at the moment. And in the short term, will be somewhere to hide from the uncertainty of earnings in the reporting season.
Okay, so no rush to be overweight on the banks, but you probably want some banks to participate in that capital raising.
If you're sitting at 60% banks, you might want to have a look at that. But if you're sitting at 35 to 40% banks for a conservative retail client, that's pretty happy.
Okay, and would you agree dialing down some of that exposure on the banks?
Yeah, I think so. I mean, I think the banks are coming into a period where earnings growth is going to be lower than it has been for the last few years. Like, they've pretty much done all they can on bad and doubtful debt provisioning. That's at historical lows. Interest rates are close to historical lows. Housing prices are close, are very, very strong on the East Coast again. So you wonder if the conditions are about as good as they can get whilst they're also having to raise capital. But I agree that they're a good safe haven. NAB's the one we prefer, and I think you can still buy that on 8.6% gross yield or so. And, even if you just get a couple of % capital return from here on top of that, that will still turn out to be a pretty good investment, I reckon.
Absolutely. So a very nice yield there from some of the banks. We do have another email from a viewer. So let's go to this one from Andrew. And Andrew asks, what's your view on SEEK? Should there be long-term concerns? Should I be selling off some of my holdings? It's done very well over the last few years. Now, we know that SEEK, a problem in terms of its learning division, and that's really impacted on its price. We're in the middle of confession season. Is this an opportunity to be accumulating shares, Ben?
Yeah, look, I think it probably is. We've owned SEEK for about 4 years now, and we've actually been adding a bit more money into it over the last couple of days. We know the business pretty well, and when you look at consensus analyst valuations, the SEEK learning division is worth somewhere between 50 and 80 cents in their overall valuation of the group. So even if that business is now worthless, and this has happened because TAFE New South Wales IT systems have blown up, and no students can actually get into the SEEK learning system at the moment. Even if that division was worthless, it doesn't warrant a $2 share price for. However, it trades on a high PE. It was priced virtually for perfection, and when you don't get perfection, there's going to be disappointment and a pullback, and it could easily underperform, I reckon, for the next 6 to 12 months. But I think the attraction to us is the international business, Xiaoping, and the emerging markets that they're moving into. That will now be over 50% of the overall group's revenues, and there's a lot further to go, we reckon. And you've got Andrew Bassett there steering the ship, who I reckon is one of the best CEOs I've come across in the market. So he's reinvesting into the placement market, which should be good domestically, and I reckon the pullback with a long-term view, I wouldn't say trying to trade it or anything, I think you'll do well. Okay,
so you think that the traditional domestic market, which is looking pretty saturated, is going to be less of earnings, and you're going to see the international component take a bigger part?
Andrew Bassett saw this 10 years ago, which is why he started to go offshore. And as opposed to like REA or car sales, who have come much later to the international party, paid much higher prices to these international businesses, he's built them from the floor up. And they're now like number one in massive economies, and could go on to become much bigger companies than SEEK Australia. So, but you've got to have that long-term view. You've got to monitor it. But yeah, we like the stock. Okay, so that was SEEK. And our final email comes from Jackson, and we're back to talking about bond yields and the impact on equity markets. He asks, there's a lot being made of the US raising rates maybe twice this year. Is that a realistic probability, and what does it mean for our market? So, Andrew, what do you think? The rising yields?
As I mentioned in the introduction, I think we're looking for the tightening in the US market was in September, is now being pushed out to December. The market's always going to have different views on when these tightenings will actually happen. I think if you think back probably 6 or 12 months, or 12 to 18 months I should say, there was some expectation by the market that the Fed were going to start to tighten then, and we saw a real lot of dislocation in financial markets, and we saw some of the emerging economies really cop the brunt of that from a currency perspective. So I think there will be definitely a tightening there, and it will happen here in the Australian market. You've already seen the market start to tick up at the long end of the curve, both in the US and also here. So that will have the flow-on effects into valuations for those high-yielding industrials. But I don't know about 2 rate rises, but definitely there's some coming later this year.
Okay, so definitely 1. The market hasn't priced in 2, so if we see 2, that might be a negative for equity markets. And I guess that brings us to our first segment. I'd like to thank both of our guests for a fantastic start to the show. Ben Clark from TMS Capital and also Andrew Tracey from JB Weir. We do need to go to a break, so we'll be back with more straight after this. Welcome to Your Money, Your Call, coming straight to you from the Australian Stockbrokers Awards. And joining me on the second panel tonight, we're joined by George Syrmalis from IQ Group and also Matthew Felsman from Shaw Stockbroking. And one of the areas on the market which has had a very volatile ride has been the biotech space. We've seen some shares do extraordinarily well, with Certex up a massive 76% over the past year and Prima Biomed up 125% over the last quarter. But this rollercoaster ride, George, it's hard for investors and traders to make profits from. So when you are looking at the biotech space, what do you look for?
Well, biotechnology is a separate industry. It has very separate criteria. So I think if one begins to look at fundamentals, they will not find them in the biotech industry. It's not to be confused with the pharmaceutical industry or the medical device industry. So in essence, a part of great intellectual property that you should be looking for that will eventually lead to a compound or a pharmaceutical, if you like, a biopharmaceutical, one should be looking at the management team's ability to develop the compound or the intellectual property to a biopharmaceutical, and the management team's ability to raise $1.5 to $2 billion, which is the necessary investment to actually commercialise the research.
Okay, and sometimes the path to commercialisation can take a long time and it can be difficult for a lot of investors and traders. So when you start to see these big spikes in share price, is it time to take some money off the table, or are you in there for the long game?
I think the investment life cycle, if you're setting as a milestone, an exit milestone, the regulatory approval is too long, because on an average it will take you 12 years' time to get it to the regulator. And it's only 20% of the teams that commence that cycle that actually make it there. And that by no means guarantees commercial success, because that's the point where a biotech actually becomes a real business. When you get it approved, all that means is that you're now able to put it on the pharmacy shelf.
Okay, so it can be a long ride and quite difficult sometimes for investors and traders to make money from that ride. Let's now go to a viewer email. We've got one here from Beverly, and Beverly asks, it's hard to see a lot of value at the top end of the market. So what are some smaller stocks you'd recommend, and should I be cautious about investing in small caps? We might go to you, Matthew, for this question. We know that a lot of the blue chips have done so well on the market, and small caps have been an underperformer for many years now. Do you see value in that space? Would you be entering the space, and what type of risks are you taking when you enter in here?
Well, look, small caps generally aren't for everyone. They're very, very good trading vehicles. But look, in terms of risk, what you always want to do if you're managing a smaller company, a position in one, is probably look to set some stop losses on your trades.
Okay.
That way, if things do fall, if they are volatile, you're not going to experience as heavy as a loss. But at the moment, when I'm looking at a small cap, is one we're actually IPOing. It's called National Vet Care. NVL will be the code. IPOs offer great value usually if you are picking up some on a pre-listing.
And why do you like vet care?
Well, look, it's a pure growth play. It's going to be listing around about what's offered to investors at $50 million market cap. Very much a similar model to Green Cross. So they're going to slot straight in as the number 2 to Greencross. Different focus on the business, no retail focus, purely professional services, and roll-up strategy, acquiring over 30 vets, and the company's run predominantly, but the board of management is ex-Greencross.
Okay, so. And when you say a rollout strategy, this strategy tends to work on the market because often vets that aren't listed on the market trade at a discount to businesses that are. So is there a valuation, I guess an upgrade that comes from acquiring those companies that aren't listed on the market and rolling it into VetCare?
Yeah, well obviously it's growth by acquisition and tying everything in together, but there's a lot of fragmented vet clinics out there in country towns and suburban areas that don't want to be a pet store. They want to be a vet and focus on the professional services. So I think they've really identified that opportunity. Okay,
so VetCare, an interesting IPO coming through, and I think Shaw's one of the marketers of that IPO. Certainly people are spending a lot more money in terms of their pets. People are also spending a lot more money in terms of healthcare as well. So coming back to the biotech space, and we do have an email here from Craig, and Craig asks about Sirtex. Sirtex has soared after its Sirtex study. Is it a good time to buy or should I wait? Well, Sirtex has both soared and crashed after that Surflox study, George. Looking at a company like Surflox, do you think now is the time to be buying when we have seen the shares performing so well over the last 5 years?
I think when you look at Sirtex, you're looking at a company that the investors have set very high expectations. So basically it's a medical device company. I do not view it as a biotechnology company. It doesn't create a pharmaceutical or a biopharmaceutical. It creates a device. That's its approval. If you look at its manifestation, it's purely a device. So does it have intellectual property? I failed to see intellectual property. Does it have a pipeline of intellectual property to be developed? Once again, none has been communicated. So in essence, I think while it's a great company, one has to really judge it for what it is. So it's a medical device company which makes a medical device and has a therapeutic indication which is very narrow, as you remember from the Surflox study which you mentioned before. So is it worth 55 times its price to earning ratio? It's very, very difficult to justify, I think. I'd like to look at something very innovative, and there's many other innovative companies in Australia.
Okay.
If you buy it cheap and if you buy it for what it is, it's probably a good investment. But
and do you have any
not
favorite?
Not a biotech.
Do you have any favourite biotechs that you've been watching?
Well, in the same space, I like Oncosil.
Okay.
Which does something very similar, and it's got a very, very reasonable market cap at this stage, and they've got some very good results up to now. I like Clinuvel, a brilliant company which has just gotten CE approval a few months ago about an orphan disease indication. I think that's enough for a moment.
So some great ideas coming there from George in that biotech space, some smaller companies there. It is time to go to our next email, so let's go to this email from Andy, and Andy asks about our view on Slater and Gordon. They had their investor update this week. They painted a pretty rosy picture. However, the company is valued at it has goodwill at $2.7 billion, or about 1/3 of the company's capital. And of course today, Slater and Gordon shares down around about 17% on the back of news that Quindell, their UK acquisition, looking at an accounting investigation at the moment. So let's ask Matthew about this one. Slater and Gordon, it's been one of the good growth stories on the market. They've made an acquisition of Quindell. It's supposed to be transformational for the company, but today, some news that the accounting is under investigation. Do you think the drop in share price that we're seeing this week makes Slater and Gordon a good buy at the moment?
Well, I think what you're seeing is people very uncertain. A lot of selling. I think I'll leave the 200 down today. And that's based on the fundamentals of the company are being questioned. The way you value a litigation funder is based on their active cases. it's the revenue coming in. So I think they had about $1 billion that was questioned on their balance sheet as working cases at the moment. So that's number one. That's got to create some uncertainty if you're questioning the fundamentals of a business or a balance sheet. And then number two, I've noticed that I think in the last, since February, the short selling interest has increased by about 4 or 5 times. So you've got probably some of the smarter money or some of the bigger funds anticipating further weakness. So I'd probably hold back for now.
Okay, so not going near Laidler and Gordon, even despite the big price drop that we have seen today?
Yeah, not at the moment.
Okay, are there any stocks in the larger space that have caught your eye? It is confession season. We've seen a number of downgrades come through. Flight Centre was a big one this week.
Yep.
Any that you'd be buying because of big price drops, or would you be staying away given that one profit warning usually leads to a number of others?
Well, look, I like the stories that are turning around where the worst is behind them, and people cringe when I say this, but QBE is a good example. They make a lot of their money in US dollars. Converting that back, the currency exchange there is a benefit. And obviously insurance businesses invest all the premiums they take from their holders into defensive assets. So, if you're anticipating an interest rate rise or 2 even in the US, we might see some of those defensive assets make more revenue for QBE. So I think it makes sense, but whether it comes along is another story.
Sure. So after a number of years, QBE insurance under pressure, the macro factors weren't in its favour, but the macro factors have turned, and high US interest rates should be good news for a company like QBE. I just want to go back to George and talk about the biotech space, because there has been lots of volatility in this space, George. And I guess the life cycle of a biotech company, as you mentioned, is quite a long one. When you're looking to profit from this space, which part of the life cycle do you get most excited about?
I think to be realistic, it's the transition from the laboratory to human testing, provided that you can realise an exit. So a prerequisite to that is to have a company which is listed on a major exchange, so there is liquidity, so one can actually realise the exit. That's the most significant part of the life cycle.
Okay, so when it does have access to liquidity, access to a lot of investors, a lot of interest coming through?
Correct, and you correlate that business milestone with the scientific milestone of transitioning from the laboratory to human testing. That's a major milestone in drug development.
So that's a really good insight. So when we do see testing moving from animal testing to human testing, yep, that's usually a positive sign for a company. In terms of the biotech space, we do see a large number of biotechs coming to the market, yep, but not all of them go on to commercialization. So what is it that sets apart the CSLs when they're, little companies, yeah, from the other ones that fall by the wayside?
I think it's solid, fundamental scientific research, ownership of intellectual property, which gives you the patent protection, the competitive advantage. And as I said before, at the end of the day, it's all about the people. So you need that management team to have full ownership of the science behind their research, but also the ability to go out there and raise $1.5–2 billion, communicate a business story which is based on those scientific fundamentals.
Okay, so lots on the biotech space, the small cap space, as well as some of the other themes that are around in the market at the moment. Thank you so much to our guests from this segment, George Syrmalis from IQ Group and also Matthew Felsman from Shaw Stockbroking. And we'll be back to answer more of your questions in just a moment. Stay with us.
Thank you.
Welcome back to Your Money, Your Call from the Australian Stockbrokers Awards in Sydney. I'm Julia Lee from Bell Direct, and joining me in this next panel we have some of the biggest exchange-traded product providers in Australia and indeed around the globe. We're joined by John Howie from iShares, Danny Laidler from ANZETFs, and also Peter Harper from Betashares. Welcome. We might jump straight into an email because we do have one from Anne, and Anne writes, what's the best ETF for US exposure? Now, you're probably going to say each of your own, but I guess the question encompasses things like currency hedging, the different US indices out there. So, John, we might start off with you. What do you think?
Yeah, absolutely. I think the most popular exposure that we've had over the past couple of years has been IVV, which is our S&P 500 ETF. obviously tracks the largest 500 companies in the US and can be bought for a low price of 7 basis points per annum. So it's one of the most cost-effective ways to get exposure to the US. We also have a currency hedged versions for clients who are concerned about what currency can do to their portfolios, and that trades under the ticker IHVV.
Okay, so two very big ETFs there. I guess, Peter, you have a little bit of a different one, and I want to ask you about the NASDAQ 100 ETF.
Sure.
How is it different from some of the other US ETFs out there on the market, and why would an Australian investor be entering into something like that?
Absolutely. Look, the key difference with the NASDAQ ETF is it's really exposure to the new economy as opposed to some of the other ETFs which are more exposure to the old economy. So you're seeing companies like your Apples, Googles, Netflix, Teslas, etc. That are really displaying much stronger growth in both earnings, sales and dividends than some of the old world economy companies, and yet it's trading at a really attractive valuation. So that's something that people should be aware of. NASDAQ's currently about 32% below its long run average PE,
wow,
which not many people appreciate. So it's very cheap compared to a lot of other exposures in the market at the moment.
Okay, and when entering into the NASDAQ, I mean, we kind of think of technology shares and the volatility that's been around in technology shares over the last few decades.
Yep.
What are some risks involved that you should be aware of?
Yeah, look, I mean, obviously you need to be aware of the currency risk, so it's unhedged. So what that means is that you will benefit if the Aussie dollar falls against the US dollar, but it will be to your detriment if the Aussie dollar rises. The NASDAQ is actually a larger cap index on average than the S&P 500. So the average size of companies in NASDAQ is bigger than the average size of companies in the S&P 500. And that's something a lot of people forget. So it does have a bit of a tilt to technology, healthcare and consumer discretionary that people should be aware of. So it's underweight something like financials, for example. But for a lot of people, that's good for an Aussie investor because we've got a lot of financials exposure here. Where we're light is technology, healthcare and consumer discretionary, and that's exactly the gap that NASDAQ fills.
Sure, so that's a very good point, that the weighting of different sectors is different in the NASDAQ 100, so not much in terms of financials. Now, Danny, going to you, congratulations, you've just launched the ANZ ETFs as well, and I guess this is a growing space, exchange-traded products being used by Australian investors, both professional as well as retail. Yes. I know you have some interesting products just concentrating on the Australian market now. You have something called the Smart Beta exchange-traded product, which I found quite interesting. So how does that differ from some of the traditional products out there in the market?
Sure, Julie. We have two Smart Beta ETFs. We have a US ETF and an Australian domestic ETF. The US one is the S&P 500 High Yield Low Volatility ETF. As the name suggests, it invests in those US companies with a higher income but lower volatility. So we take the S&P 500 as a universe. We select the 75 stocks that have the highest income. Of those 75, we then select the 50 with the lowest volatility. And by doing that simple strategy, we get a yield of around 3.7%, which is double that of the S&P 500. Now, a second Smart Beta ETF is our Australian domestic one. And really, Smart Beta just means that the fund weights its constituents by something other than traditional market cap. So whereas a traditional market cap ETF invests more money into larger companies and less into smaller companies, our Smart Beta ETF actually weights them by dividend. So in other words, we take the ASX 300 as our universe, we select the 40 stocks with the highest yield, and we then invest more into those that have a higher income and less into those that have a lower income. And again, a very high yield, 5.3% plus franking credits.
Wow, that's pretty amazing. So looking for low volatility, high yield in terms of the US market as well as the Australian market.
Yep.
And I guess, John, coming to you and looking at the breakdown of the US market to the Australian market, it is very different. I mean, in Australia, financials make up half of our market and mining companies almost make up the other half. In the US, why would you be entering into the US market?
Look, I think sector diversification is one of the main reasons that Australian investors have been looking to invest overseas, and we've seen a lot of interest in our global sector funds in the past 12 months. Those funds give access to global telecommunications companies, global healthcare companies and global consumer staples companies. And so some of the names that people are familiar with but have been very difficult to access in the Australian market, so Pfizer, Johnson & Johnson, Procter & Gamble, some of those large global organisations which have very wide economic moats, so very difficult to compete with these global organisations, and they can be purchased in a portfolio that gives you a global exposure to those sectors which are tough to get access to on the ASX.
Okay, so just putting you on the spot there, John, where have you seen the most demand coming from in terms of Australian investors for international products and even sector interest?
Yeah, particularly in terms of sectors, and this is a recent phenomenon, we see a lot of interest coming in from healthcare. So when we look at healthcare and the demographic trends that we know are occurring around the world over the next 10 or 20 years, we're seeing that healthcare will be one of those industries which continues to grow and has very strong tailwinds behind it. And at the moment, our view at BlackRock is that the healthcare sector is reasonably valued, and some of those demographic trends will allow investors to benefit from the shift in demographies around the world in those next couple of decades.
Okay, so global healthcare stocks, and some of those global giants just eclipse ours. The biggest stock on our market is CSL and the likes of Pfizer. I mean, they're just absolute giants in this space. Peter, I want to go to you. Now, Betashares has a huge range of different products, some very unusual products as well. So putting you on the spot now, which is the product that has most of your interest at the moment?
Funnily enough, the yield trade has been going on for quite a while, but it's still the yield trade that we're seeing a lot of flows in. And in that regard, there's three key funds that we offer. We have the UMAX fund, UMAX, and that's a buy-right strategy over the S&P 500. So that's an exposure that people might look at to get US market exposure, but with higher income and lower volatility.
So what would the yield be on something like that?
Look, it's a relatively new fund, but in the first quarter it paid 1.6% per annum. Which is almost equal to what the S&P 500 pays in an entire year.
Yeah.
So certainly a very high level of yield, and the volatility on that tends to be about 20 to 25% below the S&P 500. In terms of other yield exposures, we've got the same fund available over the ASX 20, and that's called YMAX, the Yield Maximiser Fund, yielding about 8.4%. And then we've got our Dividend Harvester Fund, which is designed to provide at least double the income of the broad Australian equity market plus franking, and that fund actually also has a risk management system that's designed to reduce the volatility of equity investment and cushion any downside risk. So it's really focused on retirees, SMSFs and much more conservative investors.
Okay, so the yield trade has been very attractive, especially for Australian investors and given our demographics. But I want to ask you about an interesting product. And it's the ASX 200 geared short fund for hedging. So more for the traders probably rather than the investors, and totally on the other end of the spectrum. Tell us a little bit more about this fund.
Yeah, look, absolutely. This is not the sort of fund you would buy and hold indefinitely unless you thought the market was going to perpetually fall. That said, the key use of it, while it can be used by traders, the key use of it that we've actually seen is by people hedging their portfolio. So imagine you own a portfolio of quality stocks, your banks, Telstra, BHP. You've held those stocks for a long time, but you're worried about market risk. If you want to reduce market risk, the old way people would do it would be to sell some of those shares and move to cash. But that can have adverse consequences in terms of crystallising CGT events. You can lose the income and you can lose the franking credits from those quality holdings. So the new way you would look to do that is by buying some of the BBOZ fund, the Strong Bear Fund. And what that means is that goes up in value when the market goes down. So by buying some of that, you can maintain your holding to your quality portfolio and not tinker with it at all, but know that if the market falls, you've got something else there to provide a hedge and that will help offset some of that fall.
It's amazing the range of products in that exchange-traded product space at the moment. I guess the low fees with the range of products is quite an attractive option for investors. Finally, Danny, just putting you on the spot, which one's your favourite product? It doesn't have to be your own.
We've introduced the ASX 100 ETF to Australia. This basically invests in the 100 largest companies in Australia. Now, what's interesting with this fund is it picks 50 large cap and 50 mid cap stocks, so it doesn't have any small cap exposure. And mid cap's been the strongest performing sector in Australia. That fund has a management fee of just 35 basis points and is yielding 4.5% plus franking credits. So I think that'll be quite an interesting one for domestic investors.
Okay, and just a final question. I know that when there's times of market volatility, it can be quite difficult for some products to match the underlying that they're meant to be based on. So when it comes to exchange traded products, let's say that we do see a day of big volatility on the Australian market. Let's say, not that it's going to happen, but something like we've seen in China last week where the Shanghai Composite, fell 13.5%. In terms of the pricing of these products, what does it mean for Australian investors?
Yeah, look, I think that's one of the great benefits of the exchange-traded fund structure is because it's an open-ended structure and it can be created and redeemed every single day, that allows the ETF structure to trade closer in line with the intrinsic value of the underlying assets than many other alternatives. So what you do see in times of market stress is generally the liquidity and the turnover of ETFs actually goes up because investors turn to that open and transparent vehicle as the vehicle of choice when they're looking to express a market view. And that's what we've seen in credit markets during the GFC a few years ago, for example, and that's what we've seen in Asia more recently as the volatility in those markets increases.
Okay, so more liquidity in terms of exchange-traded products. Danny, would you agree? Anything else that we should be aware of?
Yeah, no, definitely. And I think the good thing with the ETFs is they are transparent and there's plenty of people in the market making prices. So even if the market's volatile, investors can be comfortable that they're seeing good pricing on the screen.
And final word to you, Peter.
Look, simply, if you look at the key tenements of ETFs, it's simplicity, transparency, low cost. And so when you think about a volatile market, what is it that you're looking for? Well, they're the exact factors that you're looking for, and that's why people tend to flock to ETFs the more volatile markets have become. So, definitely a great time to look at ETFs if you see volatility ahead.
Okay, so a fast-growing area of the Australian market, and certainly it has been attractive to many Australian investors for the transparency, the low cost, and the range of products that we've been talking about in this segment. So thank you so much to our panellists, John Howie from iShares, Danny Laidler from ANZETFs, and also from Betashares, Peter Harper. Thank you very much. It is time to go to a short break, but we'll be back with more from the Australian Stockbrokers Awards. Stay with us. Welcome back. It's been a great show coming to you from the Australian Stockbrokers Awards. I'm Julia Lee from Bell Direct, and in the final segment of the show, we're joined by Rudi Filapek-Vandyck from FN Arena, Michael Gable from Fairmont Equities, and also Martin Lakos from Macquarie Private Wealth. So having a look at the market, we're going to go straight into a viewer email. We've got a few here to answer. And Andy asks, can you give me your opinion on the Australian share market? Should the Chinese market bubble burst? Will our economy suffer, or will it be a case of nothing to see here? And it's a great question coming through from Andy, because we did see the Shanghai Composite last week losing 13.3% in 1 week, and some of the smaller exchanges in China in the bear market in 1 week. So Martin, looking at the volatility in terms of the Chinese market, what does it mean for Australian investors and for our economy as well?
Well, Julie, I think you have to presuppose that there is a bubble and it's going to burst. Now, that's not our view. I guess to put in perspective, the Chinese market really was stagnant for a number of years, up until July last year, and it has rallied 148%. So it's basically equalised back into the Asia regional markets in terms of valuations. But there has been some hot spots, there's absolutely no doubt about that. So a 13% pullback's nice and handy. It might see a little bit more of a pullback, but the authorities are out there supporting the Chinese economy. They want stability, around 7.5% growth. They're clearly restructuring the economy. We've seen that in terms of the banking system and the way they're treating stimulation through monetary policy and fiscal policy. So we're reasonably comfortable that we're going to continue to see some stability in China. So let's assume that we're not going to have a bubble. It could pull back a little bit. What's the impact on the Australian market? Well, clearly, if regional markets keep pulling back, notwithstanding what's going on in Greece, we can do anything but pull back ourselves. But our market's not overvalued either. we're currently around 15 times for 2016. So we're reasonably comfortable that any pullback really is a buying opportunity in the Australian market.
Okay, so looking for buying in terms of Australian equities on pullbacks. Rudi, I'm going to put you on the spot. While you're here, one of the things that a lot of investors have been saying is that, you know, with the Chinese market due to go into some of the MSCI indices, that could take some capital away from Australia. Now, that's been delayed. Do you think that this is going to have an impact? If we do see the Chinese market making up a larger chunk of the MSCI indices, will we see international investors reducing exposure to Australia but increasing exposure to the Asia Pacific?
The short answer, I think, is yes. And I think we have seen that early in the year when international investors were selling. That was probably on the anticipation that they might be able to buy in China. There was also another element to this as well. One of the favorite trades over the past few months has been to be long China, short Australia. And I do believe that in that perspective, we've also been enjoying some support because some of them have been unwinding those trades as the share market in China has come down. So we actually saw some buying support coming up.
Okay, so
sometimes the story is not that black and white.
Okay, so not too black and white, but certainly the volatility and the rise that we've seen in China's market probably having an impact on the Australian market, especially with international investors that often see Australia as a almost derivative of the Chinese growth story. Let's go to our next viewer email. We've got one here from Mohammed, and Mohammed asks, are there any stocks that you think everyone should have in their portfolios? Oh, let's go to Michael on this one. Michael, what do you think?
Yeah, interesting question. I guess it depends on your time frame if you're looking at medium to longer term. Definitely for the medium term, I think there are some key themes that investors need to be aware of. For the last several months, we've been pushing investors to keep in mind that we are in an environment where interest rates are quite low, fuel prices are quite low, and we're also seeing an appreciation of the US dollar. So for us, that's driving what stocks we've been buying over the last several months. In terms of low yields, the banks are clearly an attractive proposition. I know you do have a lot of bank bashers out there, but I believe that the banks will still continue to trade at these sorts of levels for a while. In terms of low petrol prices, high US dollar, you're looking at companies with US dollar exposure, so stocks like Aristocrat, your Brambles. I know Rudi loves Amcor. That's another great pick. And in terms of lower petrol prices, it should end up with more money in consumers' pockets. So we have seen in the last several months consumer discretionary stocks have done really well. And I believe if you continue to hold those stocks at least over the next several months, you'll continue to do well.
Okay, so some great ideas there. Martin, we might go to you. What stocks should every investor have in their portfolio? Michael's talked about some of the themes driving his investment choices. What do you think?
Well, our key thematic still is seeing a depreciation of the Australian dollar. So, like Michael said, those Australian companies with large proportions of revenues overseas, particularly in the US, is clearly a key thematic. But on the domestic front, we still very much like healthcare and we very much like infrastructure. So there's a number of stocks in that space that you could clearly still feel comfortable owning. Transurban in the infrastructure space, obviously a toll road operator, very well managed. And in the healthcare space, we continue to obviously like still Sonic Healthcare and Ramsay Healthcare for the medium to longer term.
Okay, so some of these themes have been unfolding for a number of years now. The popularity of the healthcare space and the high yielding space.
Infrastructure's a few years ago.
Infrastructure as well. So are there any risks associated, or is this going to continue, Rudi? What do you think?
No, see, my theme overlaps the other two guests. I mean, I'm a big fan of what I call all-weather performers, and other people might use the term economically insensitive, which means whatever the cycle, whatever the interest rates, those companies should do well. A lot of those companies have had high valuations until recently, and a lot of people will always say like, I can't buy them. I can't buy Transurban, or I can't buy CSL or Ramsay Healthcare because they're too expensive. And what you see over the past 2 months is a lot of those stocks have been pulling back. So I remain of the view that if you have a long-term portfolio and previously your excuse was, but they're too expensive, I can't buy them. Well, now you have the opportunity. They're much cheaper now. And
Rudi, are these mainly defensive stocks that perform well in good and bad economic times, or are there some higher growth stocks in that?
Well, yes. I mean, I don't like the growth defensive theme. I think all-weather stocks are somewhere in the middle, because people say Amcor is defensive, but Amcor has performed actually quite well, double-digit growth over the past few years. So that's not really on the same par as with AGL Energy or something like that. And I think that you can discuss whether an REA group, whether that's defensive or not. I don't think it's defensive, but I think it does seem to grow at 20% a year. So the only problem you run into every once in a while is maybe a too hot valuation, and then maybe investors taking, in the short term, a negative view on the stock.
Okay. And Julia, following on with that, I think that we're probably talking on the same page. It's all about picking companies that have got sustainable earnings, because with sustainable earnings, you've got sustainable dividends. And that's to some extent why those valuations are high. The market is rewarding those companies with premiums to the market because they've been providing sustainable earnings for quite some time.
See, and that's why I love Martin. I could have said that.
I didn't mean to steal your thunder.
Lots of love on this show tonight. That takes us very well into our next email. What are your top income stocks? And this is an email from Helen. So given that you want sustainable earnings, it is becoming more difficult to find those income stocks out there. So Michael, we might go to you first. In terms of income stocks with that sustainable earnings growth, where do you find them?
Look, in terms of what we've been buying recently, I know it's a boring answer. Someone's going to throw the remote at the TV right now, but we have been buying back into the banks in the last couple of weeks. And look, at the end of the day, there are concerns about housing prices in Australia and whether banks are able to sustain the current dividend payouts. But I still believe that we are at least a few years away before we start seeing those issues unfold. So whenever you see dips such as CBA going from $96 down to 81, yielding about 8% including franking, then I think you have to step in there and start buying it. Beyond that, in terms of other stocks we've been buying recently, they're probably not necessarily classed as a high dividend stock, but stocks that still pay decent dividends but have a bit of growth attached. We like stocks like Pact Group, which is the largest supplier of rigid plastics packaging in Australia. And most recently, Mirvac, I feel, has come down to a very nice level. It's yielding a bit over 4%. As I said, it's not a huge dividend payer, but there's a decent dividend there. And I think at the right levels, you need to pick up these stocks on a dip. They've dipped about 10%. If you're going to get 10% upside in the next few months as well as the dividend, you need to go for it.
Okay, so plenty of ideas there. I probably want to zoom in on the banks. Commonwealth Bank, moving from $89 now to $79 now to about $87. Martin, is it still a buy?
Yeah, look, we think it is, because again, it fits into that broader thematic. You've got to look at a number of things for the banks. One is the capital level. That's clearly going to be not necessarily a challenge, but it's an ongoing situation for all the banks between now and 2018-19. So they're going to continue to boost their capital. And Commonwealth Bank has the best capital position at the moment. And we're going to see the other banks boosting their capital positions on the way. So that's one side. The other side is, that, again, sustainable earnings. They've gone through a major cost out program. They're ahead of the other banks in terms of their IT rollout, and they're getting some productivity gains as a result of that. So you'd always like to try and buy the banks or buy any stock on the bottom of the dip. We've seen a bit of a dip. We might see that again, and as a result of which, we still think Commonwealth Bank's a buy.
Okay, and we're running out of time. So Rudi,
Macquarie Bank.
Macquarie?
I think Macquarie Bank.
Okay, why do you like Macquarie?
Because all the stuff you can say in negatives of the
I love how you
they don't apply to Macquarie. And I think Macquarie Bank is still especially on pullbacks. And you will notice it doesn't pull back as fiercely as the other ones.
Okay, so the international growth story, the currency playing a part, you think it's going to continue to play a strong dividend?
Also the fact that they actually, if they play their cards right, which they often do, they actually benefit from volatility in the commodity space.
Okay. So Macquarie, the pick for Rudi there. On that note, thank you so much for joining us from the Australian Stockbrokers Awards. It's the largest gathering of stockbrokers in Australia, and they're here also to raise money for charity. So it should be a good night. I can see people coming in through the door. And thank you so much for our experts for a great show tonight. I'm Julia Lee from Bell Direct. Thanks for joining us.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.